Today on Perth Property Hub, I'll be speaking with Michelle Maynard, partner at Carbon Group. Michelle is a tax and accounting professional who specialises in giving advice to property investors. And today we're going to discuss the different structures within which you can purchase that investment property. Hi Michelle, thanks so much for coming on to Perth Property Hub today.
Thank you for having me.
So today I'd really like to talk to you about what people need to consider when they're looking to buy an investment property. So many of my clients come to me and it's the first time, so they are just, they have so many questions and they're not quite sure where to start, largely around what entity or structure to buy the investment property in. So can you talk us through what some of the alternatives are there?
Yeah, so there are so many things to consider when buying an investment property. And from my perspective, it all comes around tax. There are sort of three ways that a property could be. It could be negatively geared, which is where it makes a loss. The rent doesn't cover the outgoing, so you get to claim that as a tax deduction in your tax return. It can be neutral, so the income covers the expenses. There's not really a tax effect there. Or it could be what we call positively geared, and that's where the rent is more than the expenses, and therefore you have to pay tax on that surplus income. Now, depending on how the property is geared, there are different structures that you can look at to maximise the tax effectiveness. Now, that could be in your own name as an individual. Some people look at maybe putting it into a trust structure, and then I know we'll talk about self-managed super funds is also another option. But it's really important to get that advice before you go and make a purchase or before you sign a contract, and be really aware about what each of those mean.
And that's usually exactly what I say to my clients is please go and talk to your accountant first, because I might have mum and dad come to me, and mum or dad might be the primary income earner,
sure,
and the other one in the relationship is on a much lower income, and they're looking at potentially buying it as 50-50. But I guess then it depends on the overall income picture and also how long they're planning to keep the property for, as to whether they need to look at the immediate tax deductibility of the investment or the longer term capital gain that they might pay, particularly if they buy it 100% in the higher income earner's name.
And that's something that we see a lot of. People get negatively geared rental properties and they buy it solely in the main earner's income. And that's fantastic year to year, because they'll be getting a tax deduction against their higher income every year. So they'll be getting a tax refund. People think that's fantastic. However, if say 10 years down the road, they sell this investment property and there's a huge capital gain on it, that 100% of that capital gain is going to be assessed in that main income earner's tax return, which means they'll end up paying higher tax then. So you do have to do some modelling around that. I think what people don't understand is there isn't just a buy it 100% in one or 50-50 between the two. You can actually buy investment properties, say with an 80-20 split between the couples, and it's really good to look at the difference between the returns you're going to get now and the capital return in the future to try and figure out whose name it should be in.
I know also over the years, I've been in finance for 25 years, and even 15 years ago, the tax benefits, if you had something that was negative geared, were significantly better then, because our tax thresholds were higher.
Yes.
But with the lower tax thresholds that we have now, I'm often sort of having that conversation with clients saying, look, ideally you want to be maybe neutral or slightly positive, so that you're able to maintain and keep that investment property without having to have a significant amount of money coming out of your cash flow to support that investment in the long term.
This is one of the biggest misconceptions that I see with people sitting in front of me, and normally by the time they're in front of me, it's tax return time and they haven't had this planning. What people don't understand is if you have a negatively geared rental property, for every dollar that you have to spend propping that property up because the income doesn't cover the expenses, you might get on average 30 cents in the dollar back from the tax man. And the disappointment I see in people's faces when I'm doing their tax return and they're like, why have I not got a bigger refund? They're not taking into account the fact is with the negatively geared rental property, it's your tax rate you get back, not the dollars that you've actually spent. So that's when it comes to, say, a couple where one earns significantly more than the other, that planning around who we put the property in. Negatively geared is not the be all and end all, and I think a lot of people want negatively geared properties because they think they're going to get a tax benefit. But like you said, that tax benefit is going down. The average tax rate's 30 cents in the dollar. So getting a property for a tax benefit should not be your key driver.
Absolutely agree. Another question that I often get is, should I buy my investment property in a trust, like a discretionary trust? And there's obviously a lot of, different sort of tax advantages or potentially negatives about doing it for certain individuals if it's in a trust structure.
People want to put it into a trust structure because the benefit of a discretionary trust is you can choose where the income is streamed. So if the rental property makes a gain at the end of the year, you can choose who gets assessed on that income, because a trust actually isn't assessed for tax purposes, it's the beneficiaries. So if you have a negatively geared rental property, you don't want to normally put that into a trust because nobody gets the benefit of those losses. It carries forward year after year, and you only get to use those losses if the rental property makes a gain, either that capital gain or an income gain in the future. So it's not for everybody, and I'm sure you'll be able to advise, but getting financing for a trust structure is also a lot harder than getting finance for individuals. So it does throw up some challenges. So not for everybody, there will only be very limited circumstances where you would put it into a trust structure.
So generally, I guess we could say, as a general rule, if you're buying an investment property and you're wanting to build a portfolio and it's likely to be a positively geared investment, then there might be some benefits in having it in a trust structure. But if it's negatively geared and you're not able to claim those deductions against your personal income, there's really not much benefit in doing it that way.
Correct, and there are overall plans, and like you said, people might be buying a portfolio. So if you start with a negatively geared property in a trust and then you get a positive one, they will offset each other, and that's a benefit. But you really need to be mindful of the tax complications with having it into a trust structure. So it might be a better part of a bigger plan that you have. But yeah, for those sort of mum and dad investors that aren't looking to build a big portfolio, probably wouldn't recommend putting it into a discretionary trust.
The next big question, capital gains.
Yes.
So I have a client who's just come to me and said, I've paid off my home, haven't I done a fantastic job? But I don't want to sell it because I'm emotionally attached to this place.
Sure.
I'd like to hang on to it, and I'm going to rent it out, and I'm going to buy a new house. Mm-hmm. And my first sort of thing at the time is, well, that's great, but you have no or little debt on that property, so you don't have a huge sort of tax deductibility, which I guess isn't necessarily a bad thing because it'll be more positively geared. But then they're probably taking out a bigger debt on the home they're buying than they need to be. But the bigger question is around capital gains. When does that kick in on which property?
Yeah, great question. So your principal place of residence is tax-free. We know that it's one of the best tax savings we have in Australia. So when you move from your principal place of residence and that turns into an investment property, there is actually something called the 6-year rule. So when your principal place of residence becomes income producing, you have up until 6 years after that date to sell it tax-free. But there is a big caveat on that. If you move into a second home and that becomes your principal place of residence, you have to make a choice which one you're going to claim the tax benefit on. Now, you don't have to make that choice until you sell one of the properties. So we have the option to, say, 5 years down the road, we can do some tax calculations for you about which one's going to be more beneficial. If your original principal place of residence becomes an investment property and you claim the tax-free main residence exemption on that, your new home that you've moved into then becomes taxable for those years when you have the overlap of the two properties. So a lot of people think when they read the 6-year rule, fantastic, I can put my principal place of residence into an investment property and I can buy another house and I can sell the first one tax-free, and then the second one, when I sell that, that's also tax-free because it's my principal place of residence. Not how it works. But you do have the option to do some really great tax planning when you want to sell either of those properties. So make sure you do that before you sell.
And often what I say to clients, Michelle, when they come to me to finance the investment purchase is that we really need at that point in time to do a valuation on both properties, because we need to have a base point as to where that capital gains is going to get calculated from, don't we?
Absolutely. So if you have a principal place of residence that then becomes an investment property, the way that the capital gains tax works is you don't use what you originally paid for the property as your cost base. It is the market value on the date it becomes income producing. So we need a valuation on that date, and that can be the bank valuation that you get when you do the refinance, or it could be a real estate agent valuation. But I highly recommend that you get a valuation when it becomes income producing, so we can use that to calculate your capital gains tax down the future if and when you sell it.
Thank you so much. That's really broken down a lot of the misconceptions I think that are out there around capital gains and the different structures that people can consider buying in. So thanks so much for your expertise, and thanks for coming on to Perth Property Hub today.
My absolute pleasure.